Hi everyone, this is Montasir. In this lecture, I would like to explain the accounting treatment for the dividends. As we know, the main reason for investment in a corporation is to earn an income. So the shareholders waiting for the dividends from an entity. So in this lecture, we will discuss the dividends and dividends forms in a corporation. We will start with the first form of dividends is the cash dividends. The cash dividends is a common form of dividends. Most corporation distributing the dividends as a cash. So in cash dividends, we have three dates. The first date is the date of declaration. The date of declaration, also called the date of announcement, is the date on which the board of directors formally approve a dividends, so that the shareholders can know that they will receive their dividends. In the date of declaration, we will decrease the retained earnings accounts for the dividends that will be distributed. The second date is the date of record. The date of record is the date on which the company will record all the shareholders who have the legal title to receive a dividends. On this date, we do not have any journal entry. The third date is the date of payment. The date of payment is the date on which the dividends is paid formally. We have this example which explaining the accounting treatment for the cash dividends. On September 12, a company's board of directors declared a $3 per share dividends to be paid on October 15 to all holders of a common stock. So in this example, the date of declaration is September 12 and the date of payment is October 15. On the date of declaration, 40,000 shares of common stock were outstanding. So we will distributing the $3 per share for the 40,000 shares. We must make a two journal entry. The first entry we will make it on September 12 is the date of declaration. We will debit it the retained earning account for the $120,000 and credit dividends payable for $120,000. The second journal entry will be made at the payment date. We will decrease the dividends payable account for $120,000 and we will decrease a cash account for $120,000. So this is accounting treatment and journal entry for the cash dividend. The second form of dividends is the probability dividends. Probability dividends means the entity will distributing the dividends as a form of tangible probability as a fixed assets. So when an entity declares a dividend consisting of tangible probability, here we have three steps. The first step, the probability on the date of declaration should be remeasured to fair value. In other words, the entity should comparing between the probabilities carrying amount and its fair value. And any gain or loss on the remeasurement date is recognized in the statement of income. The second step, the carrying amount of the retained earnings account is decreased for the fair value of the probability to be distributed. And the third step, the probability is distributed formally as a form of dividend. So this is the three steps in the probability dividend. We have this example explaining the accounting treatment and journal entries for the probability dividend. On August 1, a company's board of directors declared a probability dividend as a form of land. to be distributed on December 1 to all holders of common stock. On August 1, the carrying amount of the land to be distributed is $50,000, and its fair value on that date was $18,000. So the journal entries to record the declaration and distribution of the property dividends are as follows. We have 3 journal entries. We have 2 journal entries on the date of declaration. The first step, we must remeasure the property or the land to its fair value. So when we comparing between the land carrying amount and its fair value, we have a gain for $30,000. It is a difference between 18,000 and 15,000. So we must debit the land for 30,000 and credit gain on the land remeasurement for 30,000. This journal entry will be reported on the statement of income. The second journal entry on the date of declaration, we must debit the retained earnings account for the fair value of the property for the property to be distributed. So we will debit the retained earnings for $80,000 and credited property dividends payable for $80,000. The second journal entry will be made at the date of payment. So on the date of payment, we will decrease the property dividends payable for the $80,000 and we will credit the land account for $80,000.